I bought Apple stock for about $100,000 and I sold it for like maybe 20 cents per share profit the next day. And I thought again that that's such a big win. But if I look back, that $100,000 trade, this was quite some time ago, would be worth $100 million today if I just held on to that stock.
Welcome to the ValueHunt podcast, and today I'm very excited to be here with Don Wharton, a long-time investor, and yeah, we will learn a lot of stuff, so keep an eye. And Don, why don't you say a couple of words before we dive into the interview?
Sure. Thanks for the opportunity to speak with you. It's nice to know that the posts that I'm putting on Twitter are getting some attention, and I think that's how you came across my profile. And you commented that I had some interesting things to say and it might be relevant for your listeners. And I'll just a fair warning, a little bit of preparation goes into the tweets before I put them out. A lot more preparation than the questions that you're going to ask me on the spot. So we'll see if the answers are as interesting, but I'm ready for you to take it away.
Yeah, I'm pretty sure we'll have a lot to learn from you. And yes, I actually came across your profile on Twitter. I don't really know how, but I found it interesting, and that's why I reached out to you. So let's see where the conversation goes. I think it's always exciting to talk with people that are more experienced than you are. So I guess that this is the case. So maybe you could introduce a bit more your background and talk on that. And I always ask this question, which is super deep, but very simple at the first glance, which is, who is Don?
All right. Well, who is Don pretty much delves into where I came from and the journey that led to where we are today, I suppose. So where will I start? I think I'll summarize by saying I think I have a different perspective than a lot of investors, and that I don't just assume that what's said or what's done is the right thing to do. I like to be different and to challenge the status quo. And I always think that there's a better way. Society evolves, our systems from investing evolve, the types of businesses that we create evolve. And I think we're getting better and better over time with experience. And I think in order for that to continue, you've got to question what's done and decide if really it's the right or the best way to do things. So for me, I guess where it comes from, challenging the status quo, was really growing up. I learned that a lot of the things that I was taught weren't necessarily true. And that kind of started me on a journey of questioning, is there a better way? For example, I was told as a child, never go into sales. Nobody likes a salesperson. I was told never invest in stocks because your great aunt Kate lost a fortune in 1929. And that continued through the generation. I was told never go to university because my father, from his own experience, he said, 20 years into my job, I'm making more than the person that just graduated. So from his own experience, he thought he was giving me the best advice not to go to university. But it's just, there's three examples. It's what you're told and what you kind of hold as truth from a young age. A lot of times you stick through those, to your own detriment through life. You stick to those theories. And so I learned to question everything. The first thing I did after college is I got a job in sales. I was told never to do that. I got a job in sales instead of working for an hourly wage, and was able to make 3 or 4 times what I would have made otherwise. And that started me on the process of going through a whole bunch of sales jobs, from selling just about everything to figure out if that was kind of my calling, I suppose. I also started dabbling in the stock market from a young age and trying to figure it out. And it really intrigued me. So flying in the face of the advice that I was given that never invest, you'll lose all your money. At some point, I kind of grasped onto maybe that's one person's experience, but look at all these other people. There seems to be so much success on Wall Street and Bay Street. And there's a lot of the really successful people seem to do so in the stock market. So I was so intrigued that at one point, that probably was my draw to get me back into university after taking a few years off. And my goal was to solve the market, really. So I went into economics, and financial economics courses were some of my favorites. Econometrics was my favorite of all. I don't know if you're familiar, but econometrics is really looking at the data and figuring out which data points are relevant to predicting a certain outcome. So my theory was, if I can figure out if weather patterns or interest rate patterns or the price of oil and supply and demand, the money supply, all of these things, like which of these data points really matter to predict the stock market, if I can put them into an econometric model, I figured that that would be my beginning. Maybe I was an aspiring young Jim Simmons, if you're familiar with Renaissance Technologies, but
I am.
it took me in a different direction, but I'm still very, very much involved in the stock market and still trying to solve the market. But I think a little bit further ahead than I was 30 years ago.
Yeah, hopefully you are. But it's actually a really interesting story, challenging the status quo from a young age and working into sales. It's really interesting, and it's a helpful mindset, I guess, when it comes to stock market, because even though if you're not directly in Wall Street and hearing all the noise, there's other stuff like Twitter and the internet where all people are talking about the same stocks, and you get like, oh, maybe I should invest. But it's good to have that mindset that you described earlier. So I find that pretty cool and interesting, actually. Maybe we can take this in a whole lot of different directions. But since you talked about making 3x or 4x the money you would have made in other jobs, regular jobs, since a young age in sales and selling a lot of different products. Why don't you speak about the value of money in your opinion? And what's your philosophy behind accumulating, investing, or distributing the money?
Well, let me go back to a book that I read years ago. Trying to remember the author. It was Wealth Without Risk for Canadians. Charles Givens, I think, was the author. And I don't know about you, but I read all these books through the years, and there's just one or two things from each of them that I kind of grasp onto and hold on to. And I think that's the value that I get from these books. From that particular one, the thing that really resonated with me was multiple streams of income. And I grew up I was told we were middle class, upper middle class. I learned that those were nice words to kind of soften the fact that we definitely weren't, a really challenging upbringing and really having very little. And so when I read this book by Charles J. Givens, and I read about the multiple streams of income, it really just clicked with me that just in case something goes wrong, you've got a backup plan. Because I didn't want to go through a scenario where, there wasn't meat for the sandwiches, or there was only one sandwich instead of two for lunch, and that kind of thing. So I kind of always wanted what I didn't have, and I was trying to figure out how to get there, I guess, from a young age. So multiple streams of income was something that really resonated. And so probably from my 20s, I started figuring out different paths that I could get in order to achieve those multiple streams. For example, I invested in real estate from a young age and thought I was doing so well because I would buy a property and fix it up a little bit and sell it and make 20,000. And I'd buy another, use that as a down payment and buy another one and do the same thing. And I did that 5 or 6 times in a row, thinking that, wow, look at this. What a wonderful way to make a living. I've made $100,000 from selling these properties. And not realizing that because I lacked the experience of knowing that that's not how you make money in real estate. You have to have a long-term mindset. And so that $100,000, just to make a long story short, within about 2 to 3 years later, the market went up. If I'd held on to those properties, I would have had about $2.5 million in value if I just held on in equity instead of just flipping. So, I mean, we're limited by our experiences. And to me, I thought, I was doing great by making 20,000 each time, but not knowing, if there was somebody that told me that, long term is how you have to view real estate, then I would have been so much further ahead. But it's the benefit of hindsight. But as long as we learn from our experiences and take them forward, I mean, next time we'll be able to apply that to that lesson learned, I guess, to future decisions. But as a young 20-year-old, I didn't know.
Yeah, I guess that's also the problem with a lot of investors. Maybe you make a quick 20% gain, but if you just held on for, I don't know, a couple of years more, it would have turned out to be a 10x or whatever. So it's really interesting for me how you can learn about investing in other fields of your life, not necessarily in the stock market or with investing in companies. And I guess you learned that lesson with your own experience, and it's pretty interesting. I would be curious to know how all these lessons translated into your current investment philosophy, because obviously you did a lot of things, sales, and you looked into let's say more trading perspective. So how has that evolved over time, and how do you look at companies now?
Great question with not such a simple answer, but let's see if I can kind of pinpoint a few of the experiences that kind of led to my philosophy now. And right now, I'll tell you what my philosophy is, and then I'll tell you, some of the reasons why I arrived at that.
Okay.
My greatest successes have been from individual companies, owning individual companies that were operated really well, really watching every expense dollar to make sure that it was a dollar well spent. There was a return there from it. And because my greatest successes were from individual businesses, what I'm doing now is I'm really focusing on companies that buy other companies. Okay. And just to boil it down simply, if you own one company and there's all kinds of competitors that are competing with you, trying to take away your market share, there's people trying to innovate and come up with a better solution to the product that you offer that might make your own product irrelevant. So there's a lot of forces that are kind of headwinds for a company to succeed. But what I do now is I focus on companies that buy other companies, and specifically serial acquirers. So companies that have a very disciplined playbook, that they pay a certain amount for a company that meets certain requirements. And one of those requirements is cash flow, and paying a multiple of cash flow. And then they take the profits from that company and put that towards more companies. And if you intelligently leverage a little bit of debt in there, if you intelligently raise equity when it makes sense, then you've got a company if it's really good at being a serial acquirer, that's a really great capital allocator. Then the product is really, the risk of having one product or two products is much less, because really the business model is being really, really great at allocating capital. Whereas any other type of company that's just product specific, there's all kinds of things that can be a challenge, that can kind of take you off your path to success, and you might have to start over again. So I'll tell you why I got there, I guess. So I've constantly, let me just take you back a little bit earlier to my days of econometrics and looking at the data. I was trying to figure out what are the data points that I can look at that will determine if a company is going to be successful. And ultimately, over the years, I've realized it's really difficult to boil it down to specific data if you're a single product company. One of the things that really taught me a lesson is that I've had really great success in a couple companies that were really, really successful one day, and then competition would set in, or external factors would set in. Something would fly in from left field, and it would totally derail that company. And I'd almost be back to square one to try to build something new from scratch again. And it really kind of cemented in my mind that a serial acquirer and really focusing on capital allocation was the right thing for me. Some of the lessons, I guess, that I've learned over the years were buying and holding is probably one of the things that most people don't really realize is as important as it is. And the model with serial acquirers, you're buying companies and you're intending to hold them forever. For me, one of the lessons I learned was buying Apple stock. Probably, I remember the trade specifically because I remember the broker saying, "Oh, I haven't done a trade for $100,000 before. I need to get 2 sets of approvals for it." And so it was a day trade at the time. I bought Apple stock for about $100,000 and I sold it for like maybe 20 cents per share profit the next day. And I thought again that that's such a big win. But if I look back, that $100,000 trade, this was quite some time ago, would be worth $100 million today if I just held on to that stock. What a lesson! What a lesson in buy and hold that was for me. If I just did my research, bought smart, and then held on. Put it in the coffee can, they say, to hold forever. Exactly. Then that 100,000 would have turned into 100 million. So it's kind of one lesson in a buy and hold strategy of which serial acquirers do. They focus on buying and hold for the long term and just taking the profits and the cash flow and continuously making new acquisitions. Another mistake that I made is using margin. Interesting story. This kind of my start right out of university. This is back in 98, 99. I noticed that a lot of people were starting to make money buying momentum stocks. And I did my research and kind of jumped in and bought some momentum plays. I remember specifically borrowing money on my credit card and every dollar that I could get, putting that into a brokerage account and then levering up with margin. And I was able to put 75,000 into my brokerage account, borrowed money for the most part, and turn that 75,000 into 750,000 over about 4-month period from 1999, the winter of 1999 to early 2000, thinking that, I've got the system that works, 75 to 750. And of course, you're extrapolating what that 750 is going to become over the next 4 months. That's lacking the experience of knowing that what goes up comes down. But right after, when the market crashed in early 2000, my 750,000 would dip down to 650, and then I would maybe sell some of the stock to alleviate some of the margin. Then it would dip again, and I would go all back in, as so many people do. They buy the dip mentality. And so I had to learn lessons the hard way, that margin can be very painful. It's exhilarating on the way up, but it's excruciatingly painful on the way down. And it proved to me that margin is something to use very, very carefully, keep it to a minimum, and certainly don't take advantage of the maximum margin amounts that your brokerage account wants you to take, I suppose. Other lessons learned that kind of led to my current strategy is having to go through the lessons of day trading and learning that, you never really hear about somebody that's really, really successful that day trades for a living. I guess you do. If you read the books by Jack Schwager, Market Wizards, I guess there are some people that have had tremendous success. But I think that would be a small percentage of the people that venture down that road to begin with, thinking that they're going to make their fortunes through day trading. I went through that, tried tons of different strategies, volatility strategies to isolate myself from downturns, buying the breakouts, more advanced strategies that if you look at the data and you can backfit the data to prove your thesis just about every time, then it works until it doesn't. Everything works until they don't. And so I totally eliminated that from my investing philosophy. So no day trading, very careful margin, if any at all. buy and hold for the very long term so I don't have a repeat of my Apple mistake. And it really landed me on focusing on the coffee can strategy, which I forgot where I first read it, but I believe it's mentioned in the 100 Baggers book by Chris Mayer, which is just an exceptional book that I wish I had when I was 20. It really resonated with me. In fact, I bought copies for all my kids, and anybody that would that I brought it up that seemed interested, I would give them a copy. I was so excited about that book and the philosophies behind it and just the data behind it. I mean, it's really, you're looking at the data. You're looking for the companies that have proven that that they work, that they're able to return a certain return on equity above a certain threshold, like 20 or 30% or more. And just buy those companies, not the ones that have a story to tell, but the ones that actually have the data to prove the story that they tell. And just kind of a simple way to boil down the strategy was just buy and hold for the long term and focus on companies that have the ability to repeat their business model in perpetuity, repeat their generation of profits in perpetuity. The longer runway, the better. Excuse me.
No worries. And that's actually a beautiful story on how you came to your philosophy. I guess I was a bit more lucky. I just found out about Chris Mayer, I don't know when, at some point. I read his book and it just clicked. And I guess we have a similar strategy. And I'm also very interested in the serial acquire model. In my YouTube channel, I try to explore that deeply. For example, I just launched a video. I don't know if you read the REQ paper on the serial acquirers.
I have. Yes, very impressive. Very impressive.
Yeah, so I'm really curious to know. Let's say, obviously, when you talk about serial acquirers, Sweden comes to mind immediately, almost. But since you are a challenger of the status quo, and most of these serial acquirers that are really successful got pretty popular in Twitter and other platforms. I was wondering, what's your strategy, and do you look for the more obscure ones, or how do you think more specifically about these type of business models, so to speak?
So, well, you're talking about what I think about every day, and that's figuring out, should I focus on a serial acquirer in the early stage before multiple expansion is kicked in, or should I focus on the ones that have been proven to really understand the model, how to allocate capital, and management has proven themselves? And of course, the risk with buying the early ones is management really, if they haven't made all the mistakes that are possible to be made yet, they're probably going to make them at some point. Whereas if I buy the ones that have been around for a long time, where multiple expansion has already increased their valuations so much, like I'm not that familiar with a lot of the individual Swedish names, but I understand that through my FinChat, I was actually able to, for the first time, figure out what the Swedish acquirers are trading at. And they seem to me to be a pretty healthy multiple, not quite as big as a Constellation Software or their spin-offs like Topicus and Lumen Group, but they're still, they're well known, and that's boosted their valuation substantially. So do I want to pay a little bit extra for the ability that they've proven already that they have, or do I want to take a chance on the early guys that haven't made a bunch of mistakes yet, and they probably will? And so that's kind of me figuring out, is there a way to look at the earlier ones, get in early at a lower multiple, but if there's a way that I can figure out if management really understands what they're doing, and then just bet on those ones early on, rather than focusing on just the more mature ones. And that's kind of where I'm set right now. But I'll give you a couple examples. One early stage company, what a great leadership team, great management team. I'm not going to give you the name of the company. It's just too small. I really liked what they had to say. They really understood the model, and it really made sense to me. And they were publicly traded. And I started buying and accumulating shares, thinking I'd like to build a meaningful position because these guys really get it. But this was probably in 2021 that I started building the position. I got to the point where I had 9.9% of the company, and
Wow.
and then the market ended up going down. Like, their access to capital wasn't really there from 2022 onwards. And one of the things that's super important with a serial acquirer is you need to have access to capital to make acquisitions all of the time. You're not,
Yeah.
if you're a holding company and you have a number of companies and you've bought, let's say, 5 or 6 companies, you're not going to be valued very highly if you're not continuing to make acquisitions. In fact, you're going to receive a holding company discount, which is typical of the public markets, if you're not proving that you're going to continue to make new acquisitions, acquiring new streams of cash flow. And so this company kind of fell into a bit of a rut where they weren't able to raise new capital at a higher valuation. And then the market went down further, and then they weren't able to raise new capital at all. And that meant that without making new acquisitions, they received a very serious holding company discount. And then if you couple that with some debt that they put on the company early on when times were good, they were really in a holding pattern, and they still are today. So it really went nowhere. So that's an example of putting a lot of money into a company early on that said everything. Their story was great. Charismatic management team. I mean, they just had everything going for them, with the exception of what was out of their control, and that was market forces, interest rates, access to capital, etc. At the same time, I also invested in another company that was quite a bit larger, but it's been around for about 7 years or so, and started building a meaningful position in that one. And same kind of thing, serial acquirer, really focused, really understand the market. But the ability to raise new capital wasn't a problem for them, and has never been a problem for them because of their focus on profitability early on. So that's my takeaway from these two examples, is always focusing on profitability and keeping expenses down is not just a nice thing to do. It's a must for serial acquirers, because you're not going to be able to access new capital unless you're a profitable company, and those profits are predictable for 3, 4, 5 years out. Because lenders, when times get a little bit tougher and interest rates go up, they're not going to give you money unless you've proven that you really understand the operational side. And that's not having any unnecessary expenses, and that's not spending on your cash flows on unproven initiatives, but taking those cash flows and banking them for new acquisitions. And that's kind of my learning from those two scenarios, that the companies that succeed as serial acquirers are the ones that really truly focus on capital allocation. The ones that struggle are the ones that think that they can take the profits made and reinvest into their existing companies rather than saving that money for new acquisitions.
What you said is pretty interesting, and I'm really curious to know why you put so much emphasis. I guess you boiled it down in the end, but I want to go deeper on the topic of raising capital, because at least for my experience, the really high quality serial acquirers, maybe the multiple expansion already has kicked in, but the higher quality ones really don't have so much needs of raising capital, just because their existing companies provide enough capital to reinvest. And yeah, obviously, when you are trying to run too fast, or raising too much debt to fund more and more acquisitions, you might end up falling or just being punished by the markets. So I'm curious to know whether your strategy allows for companies that raise capital and issue shares and take on debt, and how do you think about all those things?
Sure. Well, let's start with Constellation, kind of the most successful of them all. I mean, if you look at any graphs that are comparing the different serial acquirers, they're leagues ahead of everybody else, I think, including most of the Swedish ones as well. And I think their returns on equity are about 30% plus, and they have been for 15 or 20 years. So they're in a situation where their own cash flow that they generate internally is all that they need to make future acquisitions. But they're actually at a point now where they don't just have the cash flow, they've also got the expertise to expand even further. And it'll be interesting to see what they do in the future if they go bigger, if they go into different areas rather than just vertical market SaaS or mission critical. But they've got the cash flow to do it, and they have the expertise to do it. But if you look at some of the smaller but they've also got the multiple expansion, so you're paying a premium for all of that. So if we look at a smaller company that doesn't necessarily have the cash flow, all of the cash flow that they need to make new acquisitions, they can raise debt if they're able to. There is a very smart way to do it that a lot of people just look at debt and equity, raising equity for that matter. They look at it negatively. But if you boil it down to what value is being generated by that company on a per share basis, and making sure that the amounts of debt to equity aren't too high, you can actually really, if you boil it down to a per share basis, there's actually some really, I think, smart, smaller companies that haven't yet experienced the multiple expansion that Constellation has, but they're on the right path. So if I can buy a company that issues debt, they don't have just their own capital to make new acquisition, but they do it intelligently. Maybe their debt to equity ratio is less than 1, I would say. And then if that same company also issues new shares, on the surface, a lot of people would look at that and say, oh, there's dilution there. I don't want to buy that. I want to buy Constellation or one of their spinoffs. But to me, if I boil down that new share issuance to on a per share basis, are they creating value on a per share basis, new profits, new cash flows, an increase in owner earnings on a per share basis after each equity raise? And are they maintaining that debt ratio of 1 or less, for example? Then I'd be really interested in a company like that if they're that disciplined. It's the companies that raise equity and they're not looking at the impact on a per share basis that get into trouble. There's a company that I looked at recently that buys veterinary practices. And I looked at their stock has just been decimated, I think down 99%. Wow. And I looked into it a little bit, and it's like they're raising equity and making acquisitions, but they're not creating any value each time that they do so. So at some point, the investors that participate in those equity raises, if a red flag is going to get raised, if it hasn't already, that, wait a second, the story makes sense, but every single time you raise new equity, my share price goes down. And so hopefully they'll ask questions about really, maybe pausing new acquisitions, make the existing, in their case, veterinary practices profitable, and start creating value for shareholders before doing another equity raise. So that's an example of raising equity and making new acquisitions without being perceptive of the fact that you need to create value first so that you can make sure that each new equity raise is at a higher valuation for the shareholders. So there isn't really that dilutive effect. So those that get that, and those that get the reasonable debt amount, keep that within reason, and the focus on per share value being created for investors, then I'm really interested in finding those companies early on before they get the multiple expansion that Constellation has.
Yeah, I guess it all boils down to return on invested capital and the reinvestment rate. So
per share,
if you can't,
per share, because all those things can be great, but if it's not per share, then it's kind of just a vanity metric, essentially.
I guess, yeah. And but even if you raise equity or debt, and you are able to do that on a per share basis, as you said, you eventually end up increasing the intrinsic value of the company. I get what you say, and obviously, as a rule of thumb, you don't like to be diluted and stuff, but sometimes it's useful to look deeper, but still be aware of being diluted and not really getting the intrinsic value increase that you would like to get.
Let me give you an example of that, just to kind of show where. And there's some Twitter conversations where people kind of have piped into some of my posts, and they said, "Oh, I won't look at that company. Look at the dilution." So there's one company. I don't want to name companies on this call, but there's one company where their model is to buy new companies, buy cash flows, and then distribute dividends, share the dividends, and then raise new equity, new debt, make new acquisitions, and then increase the dividends for shareholders. So essentially what they're doing is, let's say you've got, let's say there's $1 per share in dividends. Now, let's say that company per share. Now, let's say that company raises a little bit of debt and a little bit of equity and maybe another 20 million combined and buys another company. Now that dollar per share, let's say, goes up to $1.20 per share. Now let's say they do that again. They buy another company by raising debt and equity. Even though they've taken on a little bit more debt and they've raised new equity, diluting the existing shareholders. But if they were able to make that second acquisition and increase the dividend per share from now $1.20 to $1.40, doesn't it make sense? Because it's on a per share basis. So if this company continues to do that over 5 or 10 years, 10 years from now, they could have 5 times the number of shares, outstanding shares that they have today. But if what started at $1 per share dividend rate is now $10 per share dividend payout, isn't that worth the dilution? And isn't that worth the debt that they take on to get that type of return? So that's just one example, looking at a company that focuses on paying out dividends. But there's also companies, and I can think of another one in Canada that's doing the same thing, but without paying out dividends. They retain all of that cash flow, and they put that towards new and larger acquisitions. So if you're cognizant of the per share metrics, then don't let dilution scare you away, but look at the value that's being created per share. So every time they issue new equity, are those new shareholders better off? Or pardon me, are the existing shareholders better off? And then for the new shareholders, are they made better off for the next acquisition that's made? And then so on. And for the 2 companies that I talked about, digging into the data, exactly, they are made better off each time a new acquisition is made. So dilution isn't necessarily a bad thing if you're creating value per share. And debt, as long as you make sure that you're not over leveraged and susceptible to an unexpected interest rate increase, as long as that's kept at a low level, then that's also can be very smart and augment your returns even further.
Would you think that people are a bit scared of the dilution also because it's harder to value a company when you get more dilution? Because if the share count is increasing, it doesn't look as well in the model, so to speak.
I think a lot of people just look at certain things that they've been told to look at, like the outstanding number of shares, and then they just turn away. It's kind of like a screening problem, where if you've got a few things that you're looking for, one of the common things that people look for is they don't want dilution, just because they've been told that it's a negative thing. But to really find the best opportunities, the serial acquirers that haven't realized that multiple expansion yet, you've got to look a little bit deeper, and you've got to be willing to dig into the per share metrics, which a lot of people aren't willing to do, and that's fine. But that means that's an opportunity for those of us who do look a little bit deeper.
Yeah, that's interesting. Looking where others don't look at, it's always a source of opportunities, I would say. Now, getting out of the serial acquired topic and back again to your investment process and philosophy, I would like to ask you, since you have a really long-term mindset due to your experiences and so on, how do you actually deal with the problem of the super big feedback loop that you have when you invest, say, in a company for the long run? Let's say 5-10 years from now, you really can only assess the success of your investment, say at the end of that period. So how do you make sure you're improving and you're not losing the um, the key feedback that you should be receiving from those investments?
So because I'm long-term focused, I don't need confirmation that what I've bought is working or doesn't work over the short term. So let's say I've got a basket of 10 serial acquirers. I've got a little bit more than that, but let's look at a basket of 10. Each year, and this is where the multiple streams of income comes into play, by the way, this all factors in kind of my philosophy, where what I want to be able to do is I want to be able to add to my winners. So I want to take the profits from other ventures and businesses, and I want to be able to add to the serial acquirers that have created value on a per share basis that year. And so right now, in looking at my 10, I think there's only 3 of them that have created value over the past year. Those are the ones that I'm going to add new profits to. So if I do this year in and year out, I take available cash flow and I add to my winners, I'm going to end up having very, very large positions in, and some positions that weren't winners and didn't have any money added to them that are very small and insignificant, in fact. So if you look back, let's say I did this 20 years ago and Constellation Software was in there, and there's a couple other Canadian serial acquirers. I'm kind of focused on the Canadian ones more so. Another one is called House, which was, I think, around about 20 years or so ago. If I look at those 2 companies just as an example, I would today have a massive position in Constellation and a much smaller position in House, just because I would have added to Constellation almost every single year. Another thing that I look at is Morningstar has a report available where you can enter a stock and it will show you if that company has outperformed the S&P. There's lots of ways to do this. I just look at Morningstar, but it will show you if that company has outperformed the S&P that year, and it'll show you the outperformance or underperformance over the past 10 years, in fact, versus the S&P. So it just gives you kind of the perspective of knowing how important it is to add to your winners and not to your losers. Like, don't average down. I mean, you're going to end up owning a big position if you average down in something that could ultimately go to nothing. Whereas if you average up and your focus is on compounders, and maybe one day, actually getting a 100-bagger, ideally, then averaging up is always a good idea for your best companies. But averaging down is often not a good idea because those companies can go from zero. So if I look at 2 companies, and let's say I make $1,000 investment in each, and those are the only 2 companies I ever buy, if one of them goes to zero and the other one's a 100-bagger, does the one that go to zero really matter? Not really.
Yeah, not really.
So for me, the feedback loop that you're asking about, it's really a matter of adding to my winners and worrying very little about those that don't deserve my attention, I guess, so to speak.
That's really interesting. You're basically applying a modified dollar cost average strategy.
But it's also the coffee can approach. I'm not second-guessing the choices that I made, because I put the research in and I bought those companies for a reason. So I'm giving them a chance to prove themselves and to prove out. But they're only rewarded if they continue to produce a return on a per share basis. And that reward is a continual investment whenever the opportunity arises, like huge market pullbacks or at least on a yearly basis.
Yeah, that's really interesting because let's say common sense says that you should average cost down. When something gets cheaper, you would want to add to that or buy more. But actually, sometimes the winners are the ones that carry the most weight, and over time, what matters is really adding to those winners and not to the losers. So I find that you are a true practitioner of the coffee can approach. So that's really interesting, and it takes I would say more of a psychological endurance rather than technical expertise. Obviously, you have to put in the research, and I'm not saying that you don't do, let's say, deep research on your names, but I'm really curious to know what strategies do you have in place to make sure you are consistent with that philosophy over time, because it's not just applying it 1 year and the year after you don't do anything. It's doing it over and over again for the long run. So how do you manage that emotional side and psychological aspect of investing?
Do you know the psychological side? A lot of people hear it that haven't made the mistakes or lost a lot of money, and they say, yeah, okay, that's not going to get me. I get it. I would challenge that people that haven't had the experience of being really, really wrong probably don't get it yet. Like, for example, my experience in 99, 2000 of going from 750,000 to nothing, to being wiped out, actually less than nothing, because those credit cards I continued to owe money on. So I was actually 75,000 in debt after being up 750. So I had to figure out how to pay that off so that I could get back into the game. I was taken out for several years and then had to start over again. So having that experience was quite a lesson. Another kind of experience with selling my Apple stock too soon, it was nothing really, like it hurts, but it doesn't hurt like tangible loss does. So I mean, by going through those experiences, it kind of enables me to realize that you have to stick to your system. And if you don't stick to your system, then you are going to be, there's a higher likelihood that you're going to be taken out of the market or be scared out, for example. Another thing, and something that's really huge in the system that I have that's evolved to this point, is that the best opportunities are available when nobody has money to take advantage of them. And so, for example, when the tide goes out, as Warren Buffett says, and those who, well, the story, everybody's heard that, but when the tide goes out, I mean, it's not just a matter of who's using margin and who's exposed. It's who can take advantage of that opportunity of it going out. So in order to be in the right place when volatility kicks in and the market kicks out all of those that didn't have the experience to know better, you've got to have the cash available to buy when the values are there. And so part of my strategy is to always have the ability to take advantage of spikes in volatility when people get irrational. And it actually really, really is an amazing feeling to be able to, like, if a stock that you've been watching for years gets cut in half, to be able to take advantage of that, buy those shares, and have a really low cost basis. It really kind of cements that you're doing the right thing, which really helps cement that, that you're not going to get scared out at some point because you've got that low cost basis. It's validation that the model works of having cash available. And if you look at Warren Buffett as an example, he's always got a huge amount of cash available because he knows better than anybody that when there's a huge shift in market sentiment, that's when the opportunities are available. It's hard to do when you're young and you're making small moves and you're still trying to kind of, make your fortune kind of thing. But those with experience, we should listen to. And there's a reason why he and others have cash available, and something that I've done over the last number of years to make sure that I'm able to take advantage of high volatility. When others are scared, that's the time to be, as they say, to be greedy.
Yeah, exactly. And actually, it's really interesting to see how theoretical economics or portfolio theory says you should have like 100% investment invested, because obviously cash can be a drag on your performance, at least on a theoretical basis. But that doesn't take into account those black swan opportunities that happen once in a lifetime, that you can buy, say, a Berkshire Hathaway for like 50% of the intrinsic value. So it's really a matter of being prepared when opportunity comes, as you said. And for me, that's really interesting. And cash is actually my biggest position right now. But it's not intentional. I'm just trying to find really great companies. Ideally, I would have less cash, but yeah, that's what I have right now. And I guess one question I want to ask you, just because of your wealth of experience and all the ups and downs you've had in investing and making money and losing everything, how do you keep your humility in check? I would guess it's you would remember your mistakes or something like that. But on a practical basis, on a day-to-day life, how do you keep yourself from becoming overconfident in your strategy and really being grounded?
So I'm going to take a term from my economics years. Everybody has heard of Pareto efficiency and the 80-20 rule. For me, the Pareto term that I think of often is Pareto optimality, and that's only making a change if focusing on trying to make everyone better off without making anyone worse off. So my philosophy has always been to try to improve and to try to make the businesses that I invest in, try to make my businesses that I own and build, try to make decisions that make people better off without making someone worse off. So I've kind of been focusing on not myself, but on others because of that philosophy for as long as I can remember. From my experience, if you focus on yourself and focus on in any business, if you focus on yourself, you're going to maybe get a little bit ahead, but the real gains are possible if you focus on making things better for others. And for example, if you do what others aren't willing to do, you're not going to have that much competition. Like if you're generous to a fault, if you try to create as much value as possible for your customers, then you'll have success ultimately overall, because you're going to have a lot less competition. And so for me, it's really been not about, what's in it for me. It's about how can I do the most good, and then success has come from that. So I think, to me, it's a focus that should get more attention from people. If you're building a business or in anything that you do, try to make life better, try to improve things for others, try to make a product that has a material improvement for others, and the benefits will come to you manyfold. I don't know if that answers your question, but it's kind of, I'm not really focused on, what do I get out of this? I'm more focused on, what value can I create? And happiness and success tends to come from that.
Yeah, for sure. Like I asked this question to a lot of people, including Chris Mayer and other investors, and actually, it seems to be a common theme that it's a struggle to stay grounded and humble. But part of the answer, from what I've understood and what you said right now, is really getting out of yourself and trying to really improve and provide value to other people, and that kind of gets you out of your own head. And yes, it might be one of the greatest strategies to stay grounded. I struggle a bit with this, because when you're young, you obviously are confident and want to and think you know it all. But as you learn more, basically you learn that you are more ignorant than you think you are. So by having these conversations, it's also a way for me to ground myself and really understand that there's so much to learn, and it's actually really exciting to learn from people like you. So I appreciate your answer. It means a lot. Maybe one last question, which actually could have been part of the introduction, is really understanding through which vehicle do you invest? Do you invest privately, or do you have some kind of partnership fund or separately managed accounts? How do you formally invest, so to speak?
Well, that's a question I haven't been asked before. So, through a number of vehicles now. So, I have a number of holding companies with different partners that invest. And the reason why different companies were set up is so that I could have different partners with different share ownership. I have a company that with a partner that invests in compounders specifically, and then we take the cash flow generated from those compounders to invest in more compounders. That's kind of a test to see where it'll be in 20 to 30 years from applying all of our best practices. I've got other holding companies and family trusts, as well as the most important thing to me actually is my kids' accounts, which I wish that there was somebody that taught me all of this when I was a kid. So here I am buying 100 Baggers by Chris Mayer for each of my kids and getting them to read them. And they just sit on their nightstands, and I don't even think they've opened it. Well, one of the kids does. One of the kids reads it, but the others don't. But what I did is I set up accounts for each of them that they're not allowed to touch until they're 52 years old, which is the age I was when I set up the accounts. So the youngest one has 40 years to compound, and the oldest one has about 35 years or so to compound. And in each of those accounts is a small amount of 15 or 16 serial acquirers. And so if I only had the knowledge to buy companies when I was their age that were focused on compounding, that were masters of allocating capital efficiently, I can only imagine what a $50,000 account would be worth in 40 years or so. A lot. I mean, if it compounds at 15 to 20%, if it compounds even higher, I mean, it's unbelievable what they can be worth. But hopefully I can convince the kids to, from a young age, to really understand this and to contribute to these accounts themselves. So when they each reach 52, I imagine these will be very substantial for them at that point. I also have a company that's focused on building, that's a serial acquirer as well, and has a bit of an innovative model that distributes cash monthly. So it's not a compounder per se, like a Constellation Software, but it's a fund that buys companies and then distributes the profits monthly. The goal being that when I had a software company and had profits from that company, and I first started discovering serial acquirers and really understanding the benefit here, I really wish that there was something available where I could buy smaller SaaS companies or smaller companies as an owner. The smaller companies are available at lower multiples, like under a 5 times EBITDA, for example, whereas the more expensive ones that are publicly traded are 20 or 30 or more times EBITDA. So my dream at that point was being able to invest and acquire companies at the lower end. So I created a company with a fund that enables accredited investors to actually co-own a basket of profitable SaaS companies and then receive profits monthly as if they were the owners doing all the work, except they don't have to do any of the work. So that's something that I'm working on building as well. And ultimately, in the long run, I think that can rival some of these other serial acquirers, but still a work in progress.
Wow, that's super interesting. Maybe I should have done a bit more work on your past, because if I knew this before, I would have asked more about your career as an entrepreneur, basically, because you have so many companies. I don't know how much time do you have left, because maybe we could delve a bit into that, but obviously I don't want to rob too much of your time.
Oh, no, that's fine. I can another 10 minutes or so. I don't know how much time you set aside for the call, but
Yeah,
go ahead, ask away.
for sure, for sure. Okay, perfect. So maybe you could give us a bit more background on your on what you did until today to build your capital base to do so many interesting things and set up accounts for your kids and so on. So, for example, someone like me that's just 18 years old and wants to reach to that point where you're able to to have several enterprises and holding companies and setting up accounts for their kids. Like how do you got there?
Well, this is another hour at least, but I'll try to condense it. Let's go back to 1999, 2000. So something that I was doing at the same time as finishing my economics degree is I was investigating the type of business that I wanted to build, and I narrowed it down to software. And I didn't have experience in software, but I knew that there was the highest profit margins were available in software. And I knew that it was a product that with a certain amount of fixed investment, I would be able to realize a recurring stream of sales. And so I wanted to build something. And I remember looking at Oracle, and I remember looking at it and thinking, oh my God, there's a 90% gross margin. How can that be? Anyway, it really got me digging into software. So long story short, in the early 2000s, I was so aggressive. This is before a lot of the sites were available, and there was kind of a connection to overseas with ease. But I reached out to companies in India, China, and the Ukraine to try to find a company that would build a software product for me. And the software product that I wanted to build was something that focused on malware, removing. Back at that time, I don't know if you remember, there were pop-ups were a problem. PCs dominated. The Macs weren't really around, and there wasn't iPads or anything like that. So with my brothers-in-law, we got together and we figured out how to market online. We read absolutely every single thing that Google ever put out there. This was the early days of Google AdWords, and we realized that there's an opportunity to be able to buy traffic. So just to backpedal a little bit, we wanted to build a product. We realized that the two biggest constraints that were going to slow us down were the capital to do so and the experience and the ability to market. And so we learned absolutely everything about marketing by signing up for reseller programs for other companies that produce similar products. And then we created campaigns on Google AdWords and Overture back then, and there was a whole bunch of other pay-per-click engines at the time, 7Search, Canoodle, lots of them that don't exist anymore. But we really became masters of marketing. And it's kind of like knowing absolutely everything about AI today. Very few people do. But back then, the new Google and search engines and pay-per-click arbitrage was just a massive opportunity that few were aware of. So we figured out how to market. Then we figured out how to outsource the development of a product, had the product developed at the same time that we were learning how to market through other companies. And when our product was ready to sell, we already had the campaigns all set up. So we knew exactly how much revenues we would generate on day one of launch of our own product, which is something I'm not sure can be repeated today, but it's just the opportunity that was made available through reseller programs back then. I think LinkShare was one of the sites, and I forgot some of the other ones. It's a long time ago, but when our product was ready, we knew on day one that we'd be selling, I think, $20,000 or so per day of that one product.
Wow.
So when we launched the product and we had that success, we learned very quickly what not to do in developing, and that was don't have the company that's developing your product also do quality assurance on it, because they're not going to find the problems with it that
The
they
bugs.
didn't account for exactly. So as soon as we launched, we had to take it off the market, switch those campaigns back to the other companies that we're promoting, and we had to find a local company at great expense to actually take that product and really professionalize it before we could get it back out there. And that's what we did. So we put a lot of money into that original product, but it was worth it. And that was early on when malware solutions weren't commonplace. McAfee and Symantec didn't really offer it. Rootkits were a problem. I remember hackers would use cross-site scripting and all these different tactics to get viruses into your computer and Trojans. And we hired a local team to that their only job was to go out and find the signatures that these malware that these hackers use to kind of infect our computers, and then automate it through a solution that would automatically extract those signatures out of a consumer's computer. And so we ended up building that team. Every dollar went into what we called our SWAT team, spyware analysis team, that built millions of signatures over the years to be able to protect users' computers. And that company was enormously successful for almost 20 years. And we ended up expanding into over 20 different products, from data recovery to parental controls to all kinds of tools. And then realizing probably about halfway through that there's a massive headwind that's coming. And that headwind was Apple and the iPad and the iPhone. All of our solutions were focused on the PC. And there's this new computer coming out and the iPads coming out where they were almost immune to the same malware and to hackers getting into the system. So although that company lasted for 20 years and did really well, it was just a great learning experience and enormously successful with 150 people. And it really enabled us to really understand the software space and really develop other solutions. And then in 2015, I actually through that whole experience, I acquired other companies and technologies and integrated those technologies into some of our products. But through that experience of acquiring companies, I kind of caught on to this business model. Internet Brands was the company that got my attention. I didn't even know what Constellation software was back then, but Internet Brands got my attention. And it was so interesting because this CEO was buying companies that were profitable at 4 times profit, taking the cash flows and buying new companies, and then just repeating that process over and over again. But the key thing to me was this just seemed to be a business model that was almost immune to a lot of the struggles that I had in software. And that's competitors, the cost of advertising, all these things that were issues weren't an issue for Internet Brands because they were buying already profitable companies that whatever they were doing what was right. Otherwise, they wouldn't have the profits that they were. So his only goal was to make sure that those profits continued and then take those profits and make new acquisitions and then repeat it over and over again. And I just loved that model so much that it led me to the founding of SureSwift Capital back in 2015. And that was the beginning of buying profitable companies and then ultimately learning that software as a service is really the most predictable, best types of companies to buy. And that led us to years later launching a fund to make it available to our model available to other founders and accredited investors that wanted to also co-own a basket of profitable SaaS companies. And then our second fund, Fund B, was launched in 2020, which after a huge success with Fund A, buying, I think, about 8 companies and then generating substantial cash-on-cash returns for our investors, we were able to launch Fund B based on the exact same model. And that model is distributing the cash flows each month after a reasonable management fee. So something that just I haven't seen available anywhere else. Any other serial acquirer keeps the profits and then does whatever they want with it to try to create more value for some long-term exit event. Whereas SureSwift Capital's model is to focus on profitability, being great operators, and making sure that the companies that we acquire are better after we acquire them than before. And that translates into consistently increasing profits that's distributed to the co-owners in our funds every single month. So it's turned out to be very, very popular.
That's such an interesting model, and I bet there's nothing close to that nowhere else. So where can people find your work? And me included, I'm really curious to dig in more on what you're doing with your funds and stuff. So where can people reach out to you or learn more about your enterprises and funds and so on?
SureSwiftCapital.com is the website. Sure as in SURE, Swift, SWIFT, Capital, CAPITAL.com. And that describes everything that the company is about and what we're doing and our focus on operational excellence, not just telling the story, but actually doing what we say. And we have to be great operators because every single month we're evaluated by our investors. Because every month our investors say, well, how come our distributions are a little bit lower this month? Or this is a great month, they're higher. What led to that?
No feedback loop problem there.
Pardon me?
No feedback loop problem in there.
No, we're accountable. We have to be every single month. But I must note they're only available to accredited investors. Only accredited. Something I have to point out each time. Yeah. But feel free to check it out and get back to me. Happy to answer any questions and do a follow-up call if you wish at any time.
Yeah, sure. I think there's so much more to learn with your experience and to talk about. So for sure, maybe a couple of months from now, we can have a part 2 of this chat interview, whatever you want to call it. So it was really a pleasure to have you on, and it was a big surprise to learn more about your history, because I had noticed your tweets, but I didn't know you were as interesting as it turned out to be. So it's really a pleasure to have you on, and whenever you want to get back, and we can have a part 2 for sure.
I'd be happy to. Thanks, David. This was a lot of fun. I appreciate you reaching out and the opportunity to talk to you.